Every time you tap your credit card, someone is making money. Not just the bank, not just the store. An entire financial system gets paid. And here's the part most people don't realize. Even if you pay your balance in full every month, even if you never pay a single dollar in interest, the system is still earning from you. In fact, in the United States alone, credit card companies generate over $100 billion per year in revenue, not from one source, but from a network of carefully designed mechanisms. In this video, we break down exactly how credit cards make money and why the model works so consistently. Let's imagine two people. Sarah uses her credit card for everything. She pays her balance in full every month. She thinks she costs the bank money. Then there's Mark. Mark carries a balance. He only makes minimum payments. His interest rate is 22%. At first glance, it seems obvious who makes the bank money. But here's the truth. Both of them do, just in different ways, and understanding that difference is the key to understanding the entire credit card system. Let's start with interest. When someone carries a balance, the bank charges interest on the remaining amount, and credit card interest rates are among the highest in consumer finance. In many countries, average rates range between 18 and 25% annually. Now, here's what that means in practice. If someone carries a balance of $3,000 at 22% interest and only makes minimum payments, they could end up paying thousands in interest over time. For banks, this revolving balance model is extremely profitable. They don't need everyone to be in debt. They only need a percentage of users to consistently carry balances. And statistically, that percentage is large enough to generate billions in revenue every year. But interest alone does not explain the full picture, because even disciplined users, like Sarah, still generate profit. Every time a credit card is used, a small percentage of the transaction is paid by the merchant. This is called the interchange fee. On average, it ranges between 1 and 3%. That might sound small, but think about scale. If millions of people spend thousands of dollars every month, those percentages add up quickly. If you spend $2,000 in a month and the average fee is 2%, that's $40 generated from your transactions alone. You may receive 1% back as cashback, but the remaining percentage is distributed across the financial network. Multiply that by millions of users. That's how disciplined cardholders still generate profit for the system. So why do businesses accept these fees? Because credit cards increase sales. Studies consistently show that people spend more when paying with credit instead of cash. The convenience is frictionless. Tap, swipe, done. For merchants, higher sales often justify the processing cost. And those costs are frequently built into prices, which means indirectly, everyone participates in funding the system. Beyond interest and interchange, there are additional revenue streams: late payment fees, over-limit fees, foreign transaction fees, cash advance fees. Individually, these charges may seem minor, but collectively, they generate billions globally each year. And because human behavior is predictable, a certain percentage of users will always trigger these fees. The system is built with that expectation in mind. Now, here's something more subtle. Credit cards don't just change how we pay. They change how we think about money. When you hand over cash, you physically see it leaving your wallet. When you tap a card, the transaction feels abstract, less immediate, less painful. Research shows that consumers spend significantly more when using credit compared to cash. Higher spending means higher interchange revenue. Higher balances mean higher potential interest. The system benefits from increased usage, and rewards programs reinforce that behavior. Points, miles, limited-time bonuses. Everything is designed to encourage more transactions. So when you look at the full model, credit cards generate money through interest from revolving balances, interchange fees from every transaction, fees and penalties from behavioral slip-ups, and annual fees from premium products. It's not one stream, it's a diversified revenue machine. That's why the model is so resilient. Not everyone carries debt, not everyone pays fees, but enough people do. and enough transactions happen daily. That's what keeps the system profitable. Credit cards are not accidents of modern finance. They are carefully engineered products. Used wisely, they can offer convenience and rewards. Used carelessly, they can become expensive very quickly. But now you understand something most people don't. Even if you never pay interest, the system is still earning from you. And that's how credit cards actually make money.